And next, the gentleman that I'm going to bring on stage is like no stranger to see. And I always say, I want to be just like Bill Alderman. When he's on stage, he's funny, he's witty, and he always leaves us with valuable information. And today, he's going to speak to us about operational excellence and company value. And with that, may I ask you to welcome Mr. Alderman to the stage now. I want to be just like you.
Nice introduction. Thank you, Mickey. Can you guys see my water sliding at me? Hold on. Is this level? Yeah. Good morning, everybody. I'm going to try and put some numbers on the page for us. As you know, I'm a banker, and so as Marzell said earlier, it's not really all about the money, but it is about the money. So let's have a conversation that converts some of the topics today about operational excellence into bottom line conversation. Am I in control of the slides? All right. Okay. Do I point this way? Okay. Safe harbor. You guys can read this if you want. I will make a comment though yesterday. Was it Jennifer who talked about ITAR and 6 months on some part you wanted to ship? We don't have it that bad, but I am actually regulated by the SEC. You guys are regulated by DOD, the FARs. You have a lot of compliance. My government agency is the SEC. And I don't think it's as bad for us as it is for you guys, especially with ITAR. But we have 2 regulated entities, and we have to deal with the government just like you guys do. I mentioned 2 regulated entities. One of the regulated entities is this firm over here, and I have my fun pointer. Can you guys see that this has a $ sign on it? That's my fun pointer. This is, well, come on, I'm a money guy. It's got to be $ sign. So this is what my firm does, and just 30 seconds on what we do so you know who we are. This is not meant to be a sales pitch, but just so you know where I come from. I started my career at GE, 5 years there, dealing with finance in aerospace. I got my pilot's license when I was about 18 years old. I've been fascinated by aerospace and defense since I was 1. I was born in '62, so those of us that are roughly my age, you wanted to be an astronaut when you grew up. That was just it. And so I've loved aerospace and defense since I literally was old enough to watch television. Everything I do and I've done is aerospace defense, but I've come at it from finance with GE and Wall Street, sort of as my background. We provide management consulting services to aerospace defense companies, mostly smaller companies. I am regulated by the SEC over here. This is investment banking, raising capital, mergers and acquisitions. This is how I make most of my money. This is where I spend most of my time. And this is an investment advisory firm. The SEC does not allow these kinds of entities to give investment advice to fund managers. You have to have a separate license to give investment advice. And so if we're working with a fund that wants to invest in the sector, we do it through this regulated entity. If we're raising capital for a manufacturing company or doing mergers and acquisitions, it's regulated through this silo, and this kind of work is not regulated by the government. So that's what we do. Okay, operational excellence. So value. The question is, what is value? How is it defined? We'll chat for a few minutes about that. We'll talk about how value is created and give you some examples. My view towards this topic of value is that I don't have all the answers, and sort of my views on value are irrelevant in terms of this. A client will say to us, well, Bill, we may want to sell our company or sell some equity or raise some capital. What's the value of our enterprise? You tell us, you're the expert. And quite frankly, my personal opinion is irrelevant because I'm not about to invest capital in your business. I'm the intermediary. What matters is, can I predict the behavior of the marketplace? That's my job, is predicting the behavior of others. So if Doug says, hey, we need to raise $3 million of equity, how do I do that? And how much of my company do I have to give away? Well, if you want $3 million of equity and you're worth $3 million, you have to give away 100% of your company. Who determines what your company is worth in order to go out and start that process? I can say you're worth $3 million. If the market says no, my comments are irrelevant. It just means we won't get a deal done. So it's in my best interest and my client's best interest that I can predict behavior of the marketplace accurately. And so what you'll hear from me today is not really my view of value. It's my opinion after doing this for 20 years of how to predict the behavior of those that are likely to place value on your companies. Okay? So it's my view, but it's really my interpretation of how others are going to act. Okay? How value is created. Well, then we'll take the framework of how others are going to value your enterprise. We will then look at what then will affect their view to make them think, okay, and act upon their thinking that your company is more valuable. As I said, I think yesterday, and I say this all the time, if the value of a company is based on the weather, if that's how buyers did it, then I'd get a meteorology degree. And I'd go around predicting the weather. So when Mario wants to raise money, we do that on a sunny day, because sunny days you get the most. I mean, it's literally that kind of, I'm trying to help you forecast how others are going to view your business. And I think I'm pretty good at it. I do this a lot and been successful. And so value is created by giving those people that define value what they want. It may be a little counterintuitive to the way you're thinking. It probably is consistent with how you think. But I'm going to give you some mathematical tools and models to try to quantify that behavior. Okay? And then I'll give you some specific examples. The definition of value. So how is value defined? What is it? And who says so? Okay? This is typically the first method that we see used. And as I like to say, for those, a quick question. How many people in this room have actively been involved in either raising capital or in the process of buying or selling a company in this industry? About a third. Okay. For those of you that have been through this, I hope this rings true. The typical first place you start those conversations is what's called the market method. How many people have heard the phrase comps in this room? How many people think they know roughly the comp for companies in our industry? What's an approximate comp? 16 times EBITDA. 6 to 8 times EBITDA. Okay, anybody else sort of agree or disagree with that? How many people think that's about right for this business? Okay, how many are convinced it's absolutely wrong? Okay, it's probably not a bad number for a start. That is what we almost always hear in first round conversations. Whether we're playing golf, playing whatever sport we like to play, whether Mr. Johnson sold the company and he's bragging about it, or whether someone on the shop floor overheard that some other company got sold or bought, it's, hey, the EBITDA multiple was X. Did you hear? Okay? That really is where people start. It is an easy place to go to, and we'll talk about what it is. It is not where deals get done. I've been doing this 20 years, done $1 billion, more than $1 billion worth of deals. I've never seen a negotiation completed on EBITDA multiples in my life. Okay? That's where they start. I've never seen one completed based on that. The income method. This is where we actually, when we are sitting with buyers or sellers, and we're actually in the boardroom with the real people, with the real money, and the real finance people, and the real accountants, and they're really doing the deal, 99% of the time it's the income method. And we'll talk about that. Okay? The replacement cost method is included in all of our professional valuation work. If any of you have seen professionally done valuations for litigation or for other purposes, the IRS, replacement cost is utilized. There are actually four. There's 2 market methods we'll go through. So that's really 1 and 2. Section 2 is really number 3 income method, and replacement cost is 4. This is standard, whether it's aerospace and defense or not. In the capital markets today in the Western world, those 4 methods are used by 80% of people doing valuation work. Replacement cost method in the middle market of aerospace and defense is usually utilized as a check and balance. We've agreed to this. This is what we think is right. Just let's make sure it's not too far from replacement cost. And the other place we see it often is in distress situations. Distress meaning a bankruptcy, an insolvency, a near bankruptcy, a divorce, some other activity where there's something more than a willing buyer, willing seller taking place. And we'll talk about what replacement cost is and why it would be used more often in those distressed situations. Some definitions and explanation of how these work. The premise for comps, as they're called, multiples, the market method, is that there exists a trading market for companies similar to yours and that your company should trade at a price comparable to those similar to yours. How many people here have been involved in either professionally or personally with real estate and or buying or leasing commercial real estate, by show of hands? Okay. How many people have seen comps used in that marketplace to buy and sell and lease real estate? Okay. And how many people feel it's a pretty good way to go about valuing real estate? And how many think it's a lousy way to do that? You do. I love you, Doug. Why?
Because they're not comparable. Sometimes, property just down the street is 10 times worse or 10 times better. It's on a corner lot versus a back lot, egress, all sorts of things.
So someone may throw at you a comp, but it's not a legitimate comp. But if it was an identical building in the same part of town just next door, it would have weight to you. So the issue is not the method, it's the people say they're comparable and they're not. Fair enough? Okay. Totally agree with you. And how many people think that there are many other companies that have been recently bought and sold identical to your own? I don't see a single hand. Okay. The problem with the comp method is exactly that. And when we talk about the next method, I'll explain to you why Doug's point is exactly the umbrella of why no one would ever buy or sell a company based on this, ever. And my favorite example is Mr. Johnson and Mr. Smith. Mr. Johnson and Mr. Smith have very similar businesses in the same geographic location, very similar customer bases. They're on the same programs. And Mr. Smith just got a 5-year extension on his LTA. And what was the other guy's name? Johnson? Thank you. Mr. Johnson just lost that to Mr. Smith. Would you pay the same price for both companies? They're comparable. Okay? So comps are a great way to start a conversation about value. People in their right minds don't buy and sell companies on comps. How many people have seen this formula down here below of the EBITDA multiple enterprise value over EBITDA? Who wants to define EBITDA for us? Earnings before. Okay, everybody knows this. Okay, how many have seen the revenue multiple comp used before? Okay, you can all figure out what it is. It's enterprise value over revenue. Here's one of the problems about comps on EBITDA. Not only may the businesses not be comparable or have the same prospects, but Mr. Johnson may argue that his family members are on the payroll and he sort of took them off the payroll when he calculated EBITDA. Sound familiar to some people? They call them add-backs. Who's heard of an add-back? Okay. You can play some great games with add-backs, guys. Trust me, I do it all the time. Okay? And for the smart buyers, they just throw it right out the window and say, I will look at your general ledger and I will decide what is added back and what is not. Revenue, unless you're committing outright fraud, okay, you can't play games with adding back on revenue. You either shipped it and you sold it or you didn't. Whether your assistant or your controller is a family member and they're overpaid or underpaid, you can't put that in the equation. And so what I say to clients is all the time, if you must, for your own sake, look at comps, that's where you want to start, look at revenue comps, not EBITDA comps, because it will be truly more comparable because there's not any, well, there are very few games people can play with revenue. So it's the same thing. Instead of 6 to 8 times EBITDA, you look at your peers and say, well, they traded for 0.95 times revenue, and you take some what we call noise out of the system. Okay? Same idea. We would argue it's a little bit cleaner. This is a comps table. Some of these are actually deals we've done. Some of these are deals that were not ours. And many of you may have seen these kinds of tables before. You would show dates, and this is exactly what we do in our valuation models for our clients. You show the date, the buyer, the seller, the price that was paid, and that would be the entire price, which can be a little complicated. Sometimes there's notes and stock and future payments, and so this can be a little bit muddied. The revenue number, usually we trust it. The EBITDA number, as I just said, sometimes that building next door may not be the same. Some of the EBITDA calculations may not be fair. and you have an EBITDA multiple, and you have averages. And so we had 6 to 8 as a comp, and voila, 6 to 8 is the comp on this market sample. Right? Who you pick as your comparables is critical to this method of valuation. And most would argue, professionally speaking, there's no one just like me, and my future prospects are not embedded in this analysis at all. But what would this show? So if I have $4 million in EBITDA, or if the company I'm buying rather than selling has that, and I assume that an 8 multiple will go to the high end of the chart, and my company is worth $32 million. Pretty simple math. We would argue that you should also do the revenue multiple, and we've got $25 million in revenue, 1.1 market multiple. I'm worth $28 million on that method. Before I move off of that, I assume that's pretty simple. You guys, some of you are PhDs. You're all related to mechanical engineering. You're smarter than I am. Anything more need to be discussed on the market method? Okay. Let's talk about the income method, which I will argue for the next half hour or so is the way you really need to buy, to value companies to be bought and sold, raise capital. And this will be the premise upon which I will argue you're going to want to focus for creating value for your enterprise. The premise on the income method is that an investor in your business will formulate their view of value based upon their expectations of future distributions they will receive from that business, whether it's a minority shareholder or whether it's a strategic buyer or a private equity investor that's going to buy your business. It's all about what they're going to make in the future from your business. My guess is that those of you in the room that have ever bought a copier machine or a CNC or a building or a factory or another company, this is how you've done your work. Okay? The key is that buying and selling companies or investing in companies is no different a mathematical process than that. Why would you buy a copy machine? Well, because you're going to make money on it, and you'll buy it as cheap as you can, but it's not about what other copiers were worth to other people. It's you need a copier machine. What's the cheapest price to get photocopies made? Or a CNC machine. I don't really care what the guy down the street paid for a CNC machine. What I care about is what's it going to cost me and how much money am I going to make if I put one in my building. Okay? There's relevance to what other people paid for the machine. I don't want to pay more than others paid. But if I can't make a profit on buying a new machine, why would I buy a new machine? Okay? The formula's down below. I'll get into some of the math in a little bit. There's a mathematical expression of the above statement. So here's some of the math. I'll go a little slow on this one. So discount rate. Those of you that have finance degrees will be familiar with the weighted average cost of capital. Those that are not, basically speaking, this is the rate of return that a rational investor would ask in return for investing in your business. And common sense would say that if you're a very stable, multi-billion-dollar enterprise with great prospects, your investor return is lower than a startup company that has a high risk of bankruptcy that may be inventing some wild new product that will be worth $1 billion in 3 years. You'd want an enormous rate of return for taking that kind of risk. Okay? 14% is a number we often use in this sector for companies between $5 and $100 million in revenue in the aerospace and defense industry, depending on platforms and programs and content and IP and the rest of it. The terminal multiple, getting a little bit fancy math here, but in order to quantify the income method, you've got to have an investment point, cash flows, and an exit point. You can actually model out 100 years, and I think we all would know by common sense, $1 in 100 years is worth about a penny. So eventually that model gets asymptotic to zero. It's easier and it's industry standard, instead of modeling out 100 years, to use a mathematical expression to create that asymptotic curve down to zero. The reason we use this method is because 90% of the people that invest in this industry use this exact chart. It may be a little bit different colors, different format, but it's in Excel. It goes out 5 years. It has a terminal multiple. It has a weighted average cost of capital. These numbers may be different, but 90% of the deals I've done in my life in this sector use this exact type of model. Okay? You may disagree with it. You may not want to run your company based on it. But if you ever want to raise capital or sell your business, this is how it's going to get done. Okay? We model out the cash flows, and these are distributions to shareholders. We'll talk about creating value in a few minutes based on this exact chart. For the moment, I just want to get through the chart, and then we'll talk about how operational excellence will create value. So here's this exit multiple, and we're forecasting cash flows, which I'll talk about in a bit. Basically, this is not your earnings. This is not your EBITDA. If EBITDA were $3.5 million next year, in 2008, this is an old model, and you spent $3.5 million on new CNC equipment on a cash basis and didn't borrow money to do that, your distribution next year would be zero. Okay? So this is not profits. This is not EBITDA adjusted. This is actually what a shareholder could really write themselves a check for next year. If you had $3.5 million of EBITDA and you bought a $5 million CNC machine, but you actually leased it, but you grew inventory by $3.5 million, where's Dan? We'll give you your $3.5 million inventory. It's a joke from yesterday, but Dan wants us all to increase inventory a little bit, which he'll tell us about later. But if you were to invest $3.5 million in inventory and make Dan a really happy guy, your distribution next year would be zero. Okay? And we'll talk about some of the math in a second about these numbers. So this is the distributions the company throws off. This is this exit multiple, which says that in 5 years, I'm going to actually be able to sell this business again, or sell it, for $29 million. Okay? So what I, as a shareholder, would get, if I were to buy this company today, and all these things were true, I'd get discounted value, which means 3.5 discounted back 1 year at 14% is worth $3 million. Okay? So I'd get these numbers. I get 3 million, 3 million, 2.8, 18 million. Add those numbers together. This is worth $30.1 million to me. Now, if I gave you $30.1 million for this business and you do exactly that, my return as an investor is zero. Because I paid $31 million for something that's worth $31 million. Okay? As an investment person, wearing my investment hat, why would I invest $31 million in something worth $31 million? Okay? So $31 million is the maximum price I would pay for this set of cash flows, and I'd get nothing in return. Now, if I thought the risk was lower and the risk really was 10%, that gap is my return. If I thought I could grow these distributions, that's my gain. And many strategic buyers that think that they can grow faster with you and your numbers can do better than you alone because they work with you, then the argument there is that, well, I'll pay 31 because it'll be worth a lot more someday. But this method of analyzing value is really the method that, if there's one message I have for you all today, it is this is really how your business is being valued or would be valued by the world around you. Okay? So this model says, we had the EBITDA model said we were worth 28, I think, and the revenue said we were worth 32, I think, and this one says we're worth 30.2. Okay? Let's do the fourth method. And as I said earlier, this method is normally used in situations of distress. It says, what would it cost for me to replace that business? It does include goodwill. It doesn't say, XYZ company is going bankrupt. Let's go to the auction, and when they gavel, I'll buy some machines. That's not what this is. That's true liquidation fire sale value. This is replacement cost. It says that not only do I want to be in this exact business, but I want those exact customers, those exact relationships, that exact brand name in the marketplace, those personal relationships with Boeing that company has. Okay? You can't buy those, but you can do a replacement cost analysis of them. For example, you could say, what would it cost me to have those customer relationships? Well, if I hire the best salespeople I could afford, and I did a lot of things and attended a lot of conferences and et cetera, 5 years, I think I could replicate those relationships. 4 to 5 years. Okay. Well, what would it cost? I got to hire those people. They've got to travel. I've got to spend money on travel and entertainment. You can actually build a model to try and quantify these things. Okay? But valuing goodwill, the soft things, the intangibles, is nearly impossible, which makes this method evaluation completely subjective, very subjective. which is in part why no one does it, and also in our industry, which is a mature business, where those relationships might be impossible literally to create. If Boeing wants fewer suppliers with greater abilities and higher level assemblies, a new supplier is not even a possibility, potentially. Okay? So there's a lot of problems with replacement cost. Valuing the goodwill is the hardest part, and it's an impossible quantification task, meaning you'll never know if you're right or wrong. There's truth to that with projections and the income method, but I would argue that this is even worse. How do you value process know-how? How do you put a number on a page to that tribal knowledge? Okay. The customer contracts, the supplier contracts, the relationships, the approvals. Estimations are going to be soft at best, but this is what it looks like. You would take all of those costs and model them out, literally. I'm going to have to bring in consultants for some reason. I'm going to have to hire more people. I'm going to have to buy certain manuals that this company had that I didn't have a right to buy. I've got material costs. I've got whatever these things are. Oh, sorry, back up. This is sheet metal process know-how. Sorry, I was doing a bigger picture. So this would be specifically the cost of developing internally a sheet metal process know-how of a company that I was going to create from scratch. Okay. Sorry, I was on the wrong slide. This would be the cost of theoretical cost of developing that know-how. And in this case, it's going to take me 10 years to earn that tribal knowledge. And so this might be a $2.4 million cost. Here are the actual dollar amounts I'm going to spend each year. Here's the discount factor, same as before. You discount the future dollar values. And so, you know, $174,000 in 5 years' time actually is worth $90,000 in today's dollar value. So it's $2.4 million is my best guess at what it would cost to replicate that sheet metal process know-how. I think I have another example. I thought I had another example. Okay, I don't. It's in another presentation. But goodwill, there's a number of examples that I've got on other slides of you pick what it is, customer relationships, et cetera, travel and entertainment expense. You've got the concept. So my takeaway here is that this goodwill number is the softest number we're going to talk about today. It's almost impossible to quantify. You have to try and do it. The accounts receivable, you can say that some are uncollected. They are what they are. The inventory, you can say some is obsolete. It is what it is. The property, plant, and equipment, you can have it appraised, or you can do your own appraisals and estimate what it's worth to replace. And so the argument here is that this company that we're looking at, this sample company, has a replacement cost of $21.3 million. Okay? So let's put this all together. My little star here that's spinning is there for obviously a reason. This is the income method, also called the discounted cash flow method. It's spinning there because I've made the argument, and make it again right now, it's the most important method that we use. When we do a valuation, whether it's for litigation or for M&A or for whatever reason we've been retained to do a valuation, we will weight these four methods. As I said, there's two comparable methods. Comp 1 is EBITDA, Comp 2 is revenue. This is the income method 3, and replacement cost is 4. This is relatively standard, and these are all theoretical. Replacement cost is typically the lowest. EBITDA may be the highest, but they may be numbers that have been massaged a little too much. Not claiming there's fraud, it's just there may be some subjective estimates that are not fair. And you weight them. In some cases, we'll go as high as weighting this 80%. I've never seen this in any one of our valuations above 20%. But you weight them, and you put them together. And when they all are near enough to one another, it gives us great comfort that we're sort of in the right spot. But the real issue here is that this is what the buyers do. Okay? This is how people that would provide capital to you or buy your business, or how you, my guess is, whether you're professionally going to retain experts that professionally are going to do this for you, or just in your own minds, my guess is that most of you, if you're going to buy a company, you would actually, whether you call it this or not, you're going to focus on the future earnings of that business more than anything else. Okay? So, We spent about 35 minutes talking about how value is determined by the marketplace. It actually is pretty straightforward. Some of the math is a little complicated. Are there any questions before I move to section 2 about how the marketplace values companies in our industry? Pretty straightforward. Okay. Is there any debate? Does anybody disagree and has seen examples where rational buyers or capital providers in our marketplace are acting meaningfully different than this? So is there general, how many people in this room have actually been involved in buying or selling or raising capital and from experience agree with what I've just put up there? Okay. How many with experience disagree with what I've been put up there to some degree, even a little bit? And how many people that even have not done this type of stuff before say, hey, that makes sort of common sense to me? And how many people think that, Alderman, you're nuts? Thanks, Marcel. There's always one. There's always one. Okay, so how's value created? All right. The argument that I'm going to make to the group is that you increase the expected future cash flow. I'm not saying you increase I'm not saying you increase future cash flow. I'm saying you increase expected future cash flow. I'm not asking you to commit fraud, and I'm not asking for smoke and mirrors, okay? But when you go to raise capital or sell your business or think about creating value in your business, it is more the view of the capital provider's expectations of your future than your expectations of the future. Okay? Now, typically, a seller is more fond of their business than a buyer. I mean, we become attached to our enterprises, and a lot of sellers want to sell based on EBITDA just because they pick a high number and don't need to justify it. And I'm an 8 multiple, and while, oh, by the way, I'm going to add back all these numbers to last year's numbers, and I'm worth a ton of money. Well, you know, buyers aren't going to do that, and you wouldn't do that if you were a buyer. Okay? So it comes down to the buyer's view of your future. Typically, the buyer is going to be a little, at least in negotiations, more pessimistic than you. Now, the reality is that if they can do great stuff together with you, or giving you capital enables you to really accelerate your growth, they may be, you know, saying pessimistic things and thinking optimistic thoughts. Okay? And that comes down to the art of the deal and the negotiations. But my first bullet point is increasing expected future cash flows, which we'll talk a little more about. The other one is decreasing future uncertainty. Okay? And to tie it into today's conference, with operational excellence, okay, you can give yourself the confidence, and if you do it right, give others, if you need capital from them or want to sell your business to them, give them confidence in your expected future cash flows. And I've separated the two for a reason, okay? And mathematically, I'll explain that to you. But it's not just we're going to do better. Okay? We're going to do better next year. It doesn't work in the boardroom. Okay? It's here's our plan for the future for the boardroom. And it's here's why that plan has a high degree of certainty. And they should be separated. Because just pounding the table saying I'm going to have a great year next year does not work in the boardroom. Okay? Increase expected future cash flows examples. Got some text here. I've got some quantification to follow it. And then I would like to open this up to some dialogue and try and leave about 10 minutes for that. I want to refer to some notes of what was said earlier today. First bullet point, and this was not a setup, by the way. We didn't talk before this conference, but I mean, some of this stuff naturally is going to work because I've been doing this 20 years, and these valuation methods have been proven to me that they work, and I'm a huge fan of lean and see, and so the fact that sort of these things perfectly dovetail, we didn't rehearse this. It just sort of makes sense that this all matches. So my first point is eliminate production waste. Generate same sales with lower labor or material costs. So quotes from earlier in today. And I promise you, we didn't cheat on this. Marzel said that they have been very successful in eliminating waste. It's one of his first comments. Okay, that's my first bullet point. Let's see, Robert. Let's see if I got one here. Eliminate administrative waste. Generate sales with lower indirect SG&A costs. This is not a perfect fit, but it's close. They were able to increase sales per employee, lower their costs, and lower their prices, and make a greater profit. It's close. Maybe it's off by a little bit. Mario said they were able to increase, well, hold on, let me read the bullet point. Accelerate throughput, turn inventory faster to reduce working capital. Mario said that, I think this is close, maybe a little different. After some Kaizen events, they were able to polish sheet metal at a rate of 450 per square foot per hour with less people versus prior to the Kaizen event, 250, correct? Okay. So taking out waste, accelerating inventory turns, taking out labor, they're all going to increase your cash flow. Okay. Reduce uncertainty. Now this is where we get a little bit soft. Not as soft as the issues of goodwill definition in the replacement cost method, but this is soft. And I'll show you quantitatively how we try to make that a hard number, but I will argue, and I will agree with those that want to argue, this is some soft math. You increase customer stickiness. Now that's kind of hard to put into an Excel spreadsheet. Okay? But I promise you it's in the boardroom. If you have some ability to convince a capital provider or buyer that your relationships are sticky, whatever that means to them, they will offer you either a higher price to buy your business or a lower percentage of your company if you want to raise some equity, right? That's the equation. I want to raise $3 million. I'm worth $300 million. You get 1%. I want to raise $3 million. I'm worth $3 million. You just took my whole company away from me. Right, so in that equation, the higher you're worth, the less you give away. Same, you still win, right? How do you convince that capital provider that your customers are sticky, right? And it's not a question of how you scream and yell and pound the table and show PowerPoint slides or have your investment banker bark at like a dog to convince them. It's how do you actually get them to tell themselves, as rational players in this industry, that that's a true statement. Okay? Develop strengths against global competition, management talent, state-of-the-art training. Quite frankly, all the things you do of operational excellence. And I really mean this. This is not just a sales pitch. Now, I've seen this on shop floors. I've seen this with capital providers. They walk through the building. It is lean. They talk to the employees. Everything is documented. It may be a $10 million business, but they pull me aside and say, you know what? This place hums like a $100 million company. Okay? Now, that literally will translate into a quantitative analysis that increases the value of your business. I've seen it time and time again. You can call it the soft factor, the comfort factor, the wow factor. I don't care what you call it, okay? And it doesn't matter that I and my client are impressed by my client. What matters is that the capital providers are firm believers that you have low uncertainty, okay? And all that entails. So let's do some math here, 5 minutes or so, and then we'll open it up. Okay. All right. A little preface on this one. I believe this is the exact same chart that I had previously where the company was worth $32 million. Okay? What I've changed in this chart is one number. Okay? Who knows what I've changed? Highlight. It's in green. Discount rate, okay? Discount rate is how a buyer or capital provider quantifies uncertainty. Okay? That is where it shows up. It's subjective. You can do all the weighted average cost of capital analyses and all the rest. And without getting too far into graduate level finance, here's how it works. If the company's securities of equity and debt are traded in the public markets in high volume, you can use the views of others to define your uncertainty using mathematical equations. Boeing, for example, has a WACC, and it's a really good number, and N is greater than 30, and if you're a statistician and have had graduate level statistics, you can prove to yourself that the marketplace is accurate in analyzing the discount rate for Boeing. Trust me, I took that class and did okay in it, all right? The problem is that if you don't have highly liquid securities traded in the public markets in high volume and is not greater than 30, in other words, the entire analysis is worthless. So if someone comes up to you and says, your private company with no private securities has an absolute WACC of X, they're nuts because they can't know that. Okay? You don't have liquid securities in the marketplace. So this is a really subjective number for, I think, everybody in this room aside from Dan in your company. But all of us smaller companies that are private or have illiquid securities, this is meaningless. It's subjective. So my 14 should be 16 or should be 8 or should be 12. None of us will ever win that argument. Okay? This is soft stuff because the math isn't there to support it. But I've seen this time and time again for 20 years with small and illiquid companies. The discount rate goes down when the buyer gets more comfortable. And the discount rate goes up when they're uncomfortable. Okay? If you can give a buyer comfort, whatever that comfort is, well, you know, we're concerned you need to spend more CapEx than you're telling us. Okay? That's an uncertainty. We think you're going to lose this contract next year that you're bidding on. That's uncertainty. All the things that could change your projections, right, is uncertainty. If the discount rate goes down, it's really powerful math. In this case, I lowered the discount rate by 200 basis points, 2%, from 14 to 12, and the company's now worth $2 million more. This is the weakest part of this analysis in every way. Well, what is uncertainty? How do I define uncertainty? Show me the math to prove uncertainty. Well, we're talking about the uncertainty of projections 5 years out. The whole thing is subjective. Yes. And the wonderful thing about my job, and the reason why probably my job won't be automated for 50 years, is that the capital providing process and the mergers and acquisitions process is done by human beings. Okay? And their behavior, trust me, is totally unpredictable. I'm sure you know that with all your employees. Humans do nutsy stuff sometimes. Okay? And their behavior is unpredictable. Who has teenage kids? Who had teenage kids? Their behavior, I mean, really, the M&A process can be as unpredictable as a 13-year-old girl, and I had 2 of them, okay? It's just, where did that come from, right? So it's a human process. So I can show you the quantification. I can show you what really takes place in the boardroom. But this part about defining risk and bracketing your projections is a human behavior. All I can advise you to do is the more comfort you can give the capital provider that you're going to actually achieve those projections, the greater your company's worth or the lower your cost of capital when you're raising capital. So there's reducing uncertainty. That's the softest one. This stuff gets really simple, actually. The math actually works, really works well. And although Dan wants us to slow our inventory turns and grow our inventory, which actually there's rationale for it, and I'm only picking on Dan. There is actually, we had a great argument and discussion yesterday about inventory in the supply chain. And there's some great stuff there. But being lean, being part of C, we are believers, for the most part, in reducing our inventories and getting inventory turns down. So in this case, I'm back to 14. Everything else is identical. I've reduced my inventory by these amounts each year versus my projection. Okay? So I've reduced inventory by $500,000 versus what was projected in this year. Okay? I've reduced inventory by $600,000 by what's projected in this year. And those numbers then increase my cash flow. So I was projecting in 2008 $3.5 million of cash flow. Okay? I turned my inventory faster thanks to lean or C or whatever I did, however I did it. Okay? I now have $4 million at the end of the year. The money just falls to the bottom. Okay, we all know that, right? So now, if I'm able to do all of that, my value goes from 30, whatever the number was, 30, it was 32, it was 35. That may be wrong. I've gone up $5 million. It may be only up, here we go. Yeah, there we go. From 30 to 35.1. I think that's right. Isn't the previous one 30 as well? Yeah. Okay. So I'm being consistent, and in this case, I'm up $5 million. Okay? Let's go to another example, better equipment utilization. So in this example, I'm able to use my CNCs, my cells, more effectively than I had planned, or the previous model. And I'm reducing my capital expenditures by these amounts each year. Okay? And again, it just falls to the bottom line. In my previous model, maybe I had $6 million of EBITDA, and I then spent money on CapEx, or whatever the case may be. And there's your numbers. Okay? The issues of operational excellence, okay, the soft side of it, of comfort and confidence that I do a good job, I'm the first guy to tell you, it's hard to quantify. You can do it, and I see it every day. It's hard to actually put a real number on it. things that you do for the most part with lean that are actually tangible, the inventory turns, the reduction in capital expenditures, the greater sales per employee, those numbers can go right into a model. And I mean, they're there. Okay? I see them all the time, and capital providers believe this. Okay? If you're on the road, if you're really doing it, if you got your inventory, if your inventory turns are on an absolute trend, every year they're going down by 1 or 2 days, or whatever your metric is, you will be able to get buyers and capital providers to buy into some of that. So if you're projecting a little bit of improvement every year, and you're part of the C roadmap, or you're lean, or whatever you're doing to get there, okay? I don't want to make this just a sales pitch for C. But if you've got the processes and procedures in place, and you've got this track record going, and you're projecting a little bit more improvement every year, you're going to be able to convince certain buyers and capital providers it's true. Now, I've seen clients out there that are not lean, they have no roadmap, and they go, inventory is going to go down by $1 million next year, and we're going to grow at 12%. Trust me. I trust you. I don't matter. Right? Buyers go in there and rip those parties apart. Like, prove to me, how are you going to get inventory down? Oh, we're going to work smarter. Okay, great. Okay. Not only do they take the inventory reduction out of their model, they take the discount rate up when they hear that. Okay. Some closing remarks here, and then we got about 5. I was trying for 10. About 5 minutes for question and answer. So here's my takeaway, I guess. Who determines value? You don't determine value. You may set your price. You may decide at what levels you're willing to raise capital, or if you're going to sell your business or buy a business if you're on the other side. You can determine sort of how you want to operate. But the external marketplace that's primarily going to provide you capital or buy your business someday is going to set the value. And if you want to increase your value based on how the marketplace is going to respond to you, then you've got to create value based on their rule book. That's my point. And their rule book, there are 4 methods that most buyers will use. We've gone through them. Okay? The point that I want you to take away from this is discounted projected cash flow is the #1 issue for you to fight upon. Okay? It's where you should be focused every single day. And the chart that I showed earlier that had the income method, discounted cash flow at 40%, that's the lowest number I would ever go in terms of presenting a professionally done valuation. I've gone as high as like 60%, 70% in some cases. Okay. And how is value created? I just said this 2 minutes ago. By increasing your future cash flow, expected future cash flow, and by decreasing uncertainty around that cash flow. It's pretty straightforward. And I've been doing this 20 years, and that's 90% of the time, this is exactly what we see. And so my final comment before I open it up for questions is, we all hear about EBITDA comps, and it is what 80% of the conversation is in the industry and the buzz, and who bought who and who raised money. It was the EBITDA multiple, the EBITDA multiple, the EBITDA multiple. Okay? And it matters. I've showed you that there's some value to that assessment. But do not drive your business, and do not expect to be able to sell your business or raise capital based on an EBITDA multiple. This is how it is done. With that, I'll turn it open to questions from the floor. I think we have about 5 minutes. No questions?
In sales, in transactions 20 million and less, what's the trend on the sellers or using bankers and brokers and that type of stuff? Sometimes it seems like it's just that people know each other, and somebody needs a packaging company, and they've known Bill for 20 years, and they just go through it, get their attorneys, and break it. What's the trend? Would you see it, and did it change when the downturn hit?
It's a great question, and I'll go is there a way to go back to the first slide real quickly? There's not, is there? Okay, thanks. The answer is common sense. The biggest firms will go downstream when there's less fish big fish in the big waters, right? So they're bringing their trawlers, and they'll go and they go where the fish are, to a point. And so the greatest education I got was not in graduate school. It was actually working for GE when Jack Welch was there. And the one lesson that I learned was try not to compete. That was Jack's strategy. Don't compete. Go to places where you have almost no competition. We all have competition. But this business model of mine was designed really with Jack Welch's sort of guidance, not personally, but corporately, in mind. And that is that there are really no other firms that do exactly what I do with companies as small as I deal with. And I've set up my cost structure and infrastructure so I can do this for $20 million companies. Most investment bankers with overhead, support staff, and all the rest of it, they can't afford to do a $20 million deal because the fees aren't there. What you find for the most part in the less than $50 million marketplace are people that will do deals in any marketplace, and they're also real estate brokers and other things, maybe a lawyer that does a lot of this type of work. There are some, but I would argue there's very few guys like me that are aerospace and defense expertise that make a living doing M&A with small companies because the fees aren't high enough. And I can tell you about my cost structure later, but I've kind of managed some very tight costs. But I will do a sales pitch here and say that if you're going to buy a machine, you're going to buy a piece of real estate, you're going to buy anything or sell anything, unless it's an activity you do every day, you probably want someone that's an expert to give you a hand, and you probably want competition. And the real role that I play in the market for small companies is the same that Goldman Sachs plays for big companies. It's not that they really do anything more than create a competitive marketplace. So if you're going to sell your business, if I was a buyer and you're only talking with me, that's how I want to buy your business. Because I know that there's a really good chance I won't have to pay a market price. I can negotiate a better deal, right? I mean, look, when you have a customer come to you and they say, I'm not shopping for this, what's your price? Right? That's a great day, right? Right? I mean, how many would like it with Boeing would knock on your door and say, we're not bidding this out, would you like the work? Okay? Okay? How many when you go to your supply base, go to your suppliers and say, not talking to anybody else, give me a quote? So why would you raise capital or sell your business? By calling up a company and say, hey, I'm not talking to anybody else, give me an offer. Right? And that's the role that I play. It's very difficult and sort of inappropriate for a private business owner to call up 50 companies and say, I'm for sale this week, give me a bid. The role of an investment banker enables a competitive marketplace. So if that answers your question. Yeah.
Bill, through your 20 years of experience looking at companies, buying, selling, that type of deal, would you say that it's almost self-fulfilling, reducing future uncertainty also creates more income, and then maybe flip that around a little bit. Maybe you're not looking to sell. Maybe you're just looking to create more value for future sales. Again, reducing future uncertainty for your customer, your current customer, creates more value for your current customer, as well as you probably will get new customers. Can you comment on
Sure. I think the question you're asking is about financial legs or strength of the business, or its liquidity or capitalization. So the reason I keep coming back to selling your business, I want to address that. There's a reason I do that, other than just looking for work for myself. But you know, Dan can speak to this directly, and maybe he will. Smaller suppliers have high risk, and that's not because Boeing's buying you. It's because Boeing is relying upon you that 787 is going to get frozen in that assembly line if you don't deliver on time. That's a huge risk. Okay, and we're talking massive risk. So if you are on the verge of bankruptcy or missing payroll or missing payments to your suppliers, you can't take the risk. And so depending on what you disclose to Boeing and how you disclose it, but the more valuable your business is, the less risk there is to Boeing on an operational perspective. That's exorbitantly valuable in terms of winning more contracts. So absolutely, the stronger your business is financially, the better you are from a sales and marketing perspective in this marketplace. Okay? Totally agree. But the issue of value is this. I've got some clients that are 35 years old, valuable companies that they own or built or whatever, and they're like, you know, Bill, you're a great guy, I like what you say, but I'm not selling my business for 20 years, you know? I may never sell my business. I've got clients that are in their 60s, they're like, I'm just never going to sell the business. It's fine. You don't have to. But why do you go to work every day? I mean, you know, why do you go to work? Well, my employees, my customer. No, you're a business, and you want to be more valuable and more profitable every day, if you can. And whether you're going to give it to your kids or give it to an employee or do an ESOP or sell it or raise capital, I mean, the reason for C, the reason for lean, the reason we go to work is to create value in our business. And so whether you may not be thinking you're going to sell in the next 5 years, my argument to all of you is you should be thinking about creating value in this framework every day, because if you ever are going to sell or ever want to raise capital, or quite frankly, your customers, this is how they're going to value you. Hilda, you want one more, or Mickey? Or, okay, one more question if there is one. I think we're good. Oh, one more.
Great presentation, by the way, correlating the operational excellence to increasing the value of a company.
Thank you.
My question is, can you correlate the same analogy to securing a line of credit? As you know, the state of the economy currently, for small companies, is harder and harder securing that. Yeah. Can the same analogy be applied to securing that line of credit?
Great question, and raising, doing bank lines of credit is not a big part of our business, quite frankly, because the fees aren't high enough, okay? I run a business too. But we have clients. I have a client right now, it's about a $25 million business looking for a line of credit. And we do that work less frequently than we do other work. Absolutely. The analysis, the work that we do for that client that's going to its banks is almost identical to the work we would do if we were actually going to sell that company. Because those people at the bank, they're financially trained, they have the financial degrees, it's the same math. And so to them, the banker wants to make sure you can repay the loan. They don't care if your equity grows in value per se, they want to make sure you can pay the loan. But the math is identical. If you have less cash flow each year, and if you have higher uncertainty, maybe the equity doesn't do well, but more important to them, can you repay my loan? It's the same mathematical model. It's simply, and this is the terms they use, they're more senior in the model. So, if everything goes poorly, they get repaid first and the equity gets wiped out. But, if the equity is getting wiped out, then they're at risk. And so it's the same exact financial model, exactly the same. Okay. Thanks, everybody.